Morning all. We finally got a little bit of a summer. Gosh, all those retailers that have been discounting. I mean, everyone buys stuff online, even I do. Gosh, the number of sales for, buy one, get one free, buy two, bundle deal, everything. It must be tough actually being a retailer. It's almost as bad as being in hospitality. It's so it just fluctuates. Yeah, big time. Yeah. Anyway, the sun is shining, and if you haven't got your summer wardrobe, you'll have to go and buy it. But the good news is there are lots of discounts around, as always. 24th of June week starting this week, the final week of June, the final month of Q2, and the final month of H1. That's the first half of the year. So there can be some shenanigans towards the close of play on Friday, especially with the PCE data out. It might be quite an interesting day. Stuart alluded to how tough, the Forex has been, and there are lots of sort of competing factors that make it rather volatile. We discuss every week the probability of rate cuts. We started the year at 7, we went down to 5, we went down to 3. This FedWatch tool is always being updated. It's constant, it's real time, always updating. We are the 24th of June, and year to date we've had no rate cuts, none. And this has a direct impact on foreign exchange markets, especially the dollar pairs. Obviously, with rates remaining high, investors and traders tend to keep their money where they can get a better yield. And with rates remaining higher for longer in the States, that's why the dollar has remained quite steady. And anything that implies or suggests that the Federal Reserve could be cutting rates will weaken the dollar. That's how it works. Of course, we've got a lot going on this year. 45% of the world's democracies are voting. We've got an extra one happening this year that wasn't planned in France. So over the next couple of weeks, we've got UK and French elections. Two very important democracies within Europe, not the EU. We're not part of the EU and certainly not part of the Eurozone, but it's important for the makeup of Europe. On that subject, Eurozone markets are still a little bit uncertain about what's going on. The threat, I should say, of a possibility of a far-right government in France run by Marine Le Pen, daughter of, is it Jean-Luc Le Pen? I can't remember his name now. Anyway, Mr. Le Pen, he's very old and's got dementia, but he was, an out-and-out racist from what I recall, and a xenophobe. But Marine Le Pen has definitely managed to modify RN, Ressemblance Nationale, and it's doing a lot better in the polls, polling at 34%, while the Left Alliance has improved slightly to 29%, and Macron's centrist alliance party, I should say, it's got 22%, so it really is trailing. But there was a poll out on Thursday last week that by Harris that puts the RN on course to win 235 to 280 seats. I mention the numbers because it's quite important, because to get a majority, any party needs to have a minimum of 289 seats to govern. What I mean, to govern without any alliance, without any coalition partner. And there aren't many that are going to join forces with RN for obvious reasons. And I think this provided a little bit of relief to the bond markets and some relief, to equities as well. And I think the greatest concern is that RN achieves an outright majority of seats. Anyway, by close Friday, I think have I got French equities? If I haven't, I can put them in. Just have a quick look. Indices. Yeah, there you go. FRA 40. There we go. There's the CAC. Had an awful week the previous week, but last week It managed to recover. Looks like it's recovered maybe 1.5%, 2%, but certainly nothing like offsetting the 6% fall the previous week after Macron announced the snap election. So, yeah, I think it's going to be uncertain until we get the results from the French election, and the initial one is at the end. I think it's on Saturday this week, and then we have a runoff later on after our election here in the UK on the 4th of July, and I think it's the following weekend. Anyway, that's what's happening in France and Europe. Let's have a look at S&P. In fact, let's have a look at the Dow. Yeah, I mean, that's something that Stuart was talking about. When you look at this picture here, this is when you compare this with that. The S&P's making record highs. The NASDAQ, the tech stock focused index, record highs. And yet when you look at the Dow, so the Dow Jones industrial average is made up of 30 stocks that are not market cap weighted, they are price weighted. And the makeup of the Dow is chosen by a committee. I think it's the Standard & Poor's committee. Anyway, it's always been the headline grabbing index. Whenever you tune into a news station or whatever, in any media, it says the Dow Jones was up, the Dow Jones was down. It never says, no one ever says the S&P 500. I suppose it's more difficult to say, isn't it? And the NASDAQ 100. They tend to focus on the Dow, which is probably the least important one in a way, because anyone who trades equities in the States, anyone who manages money on behalf of anyone in the States, and indeed in the rest of the world, they focus on the S&P 500. And the S&P 500 contains the top 500 companies in the US by market capitalization. Yeah. Anyway, talking of capitalization, yeah, markets, as I said earlier on, the Dow had a good week, up looks like about just short of 700 points. So that trade that Stuart was referring to, more than 400 points up. And if you're still running it, that could have some way to go without me putting a hex on it. Anyway, when you look at the likes of the S&P and the NASDAQ, both contain Nvidia. Now, we know about Nvidia. We've talked about Nvidia. It's the chip stock manufacturer whose chips, these super chips costing $44,000, is in huge demand because of their power in running these large language LLMs, large language modules for AI and other things as well. Anyway, Nvidia continued its remarkable run last week by becoming the most valuable publicly listed company in the world at just a mere $3.34 trillion. Yeah, $3.34 trillion. It's a number that you'd struggle to write down and get the noughts right. Anyway, it's pushed Microsoft into second and Apple into third spots. And they are both $3 trillion companies as well. Anyway, the boom in AI is the reason, but it might be driving Nvidia higher as the frenzy in the prospects for the company drives the stock to all-time highs. There's not been much of a pause in it, literally since the start of the year. In fact, I think over the last couple of years, it started 23 worth about 350 billion. So you can see it's gone up. It's just huge. Anyway, but according to the Financial Times, the rise in Nvidia stock price accounts for a third of the S&P 500. So when you look at this move this year, going back to the start of 24, a third of this rally is down to one single stock, Nvidia. You can see the problem, of course, the market breadth. A lot of stocks are not tracking Nvidia higher. In fact, the FT also reports that half of the AI stocks that boomed last year, and I think there's an index of AI stocks that you can track. I can't remember what it was. I think it's managed by one of the banks. Anyway, half the stocks that boomed last year have in fact declined, partly, well, mainly because many of these AI stocks have actually failed to back up the hype with any actual results or any progress that might suggest they're generating substantially more revenues, like Nvidia. Nvidia's earnings have just gone through the roof. Anyway, the mood in the market, US market, generally remained quite positive last week, with data pointing to a rosier picture. And I'll just have a quick look at some of the data that came out. It's the 16th, wasn't it? Yeah. So generally good data. We ended the week with some pretty strong flash readings for manufacturing and services sector in the US. It's sort of been under the cosh a little bit over the last few months, but manufacturing and services really jumping, beating expectations. In fact, services, which are the largest sector by some measure in the US and indeed in Europe, especially in the UK, the service sector jumping to 55.1 against expectation of 53.4. So yeah, and I think that the recent CPI data, when did it come out? A couple of weeks ago, 2 weeks ago this coming Wednesday. I think that's encouraged investors to bet there will be 2 rate cuts this year. But remember, it's not all plain sailing, because the Federal Reserve, or the FOMC that sets rates at the Federal Reserve, they're saying they expect to cut rates just once this year. Anyway, we know this changes, and just because the Fed says something doesn't mean it's going to happen, partly because they can only give us an update every time they meet, whereas this CME group, the FedWatch tool, is real time. It's giving us a renewed view every minute of the day. Yeah. Anyway, the current projections imply a cut in September, which you can see here. So currently targeting, rates currently 5.25 to 5.5. They're expected to fall to 5 to 5.25 in September, i.e. a rate cut. And then you have to then move to December for another rate cut. The probability or possibility of that rate cut, though, has actually declined a little bit over the last week. But anyway, it's still likely that we'll get a second rate cut in the US in December. Of course, we've got this inflation data out due on Friday this week. We get more inflation data out over the months to come, and that's what will influence the Fed's decision to cut rates. The market will constantly update this graph here, and we'll have a view as to what rates are going to be. And that's what drives asset prices. That's what drives the dollar. So it's important that we understand that. Okay, question about, yeah, we had UK inflation. That is right. So there we go, a UK CPI. Okay, the question is, inflation hitting our target, why no rate cut? Well, I think one swallow doesn't make a summer. The fact that it has hit 2%, I mean, it's remarkable that it has hit it. The Bank of England's target is 2%, and that's the first time the CPI measure actually has been at this level in 3 years. And I think the inflation rate in the UK is now below both the Eurozone and the US. And this is amazing when you think about it. Despite, we hit peak inflation at 11.1%, far higher than both the EU and the US. Michael, no rate cut, election influence. No, you're right. No, I'm not saying I was expecting a rate cut. What Michael is saying is that the Bank of England can't be seen to be taking a side. And if they cut rates now, it looked like they were trying to help Rishi Sunak. But ironically, the economy is doing a lot better than it was in January. But actually, you look at some of the headlines and it talks about the No, it's not there. But it talks about the Conservatives losing what is it? A third of their voters since January polls. Why? It's a bit like in the US. Biden is not trusted on his financial management. But the economy is doing really well, a lot better than people had forecast. Hence the reason why there aren't so many rate cuts now expected in the US. And here in the UK, we're not the sick man. Yeah, come on, Farage, says Connor. Yeah, uh, he does stumble though when he gets asked some quite sort of serious questions, of course. But he's a populist, and populists can make big progress, and that's partly down to reform, but it's partly down to the fact that a lot of people just want to change. But a lot of people feel uneasy about it, which is quite interesting. I've been reading a lot about this polling. But is it good for the country that we have a dominant party with a huge majority? I don't know. Time will tell, eh? Anyway, here in the UK, as I said, the inflation rate is below EU and US levels. So you might ask that question, well, why has the prospect, okay, so the prospect for a rate cut in August has actually subsided a little bit. Before the inflation data last week, the probability of a rate cut was 45%. After the inflation data, which, by the way, hit our target, hit the Bank of England's target at 2%. It was 11.1%. It's 2% now. It's still not good enough for the MPC to cut rates because the probability of a rate cut has fallen to 33% from 45%. Why? Well, the main reason is when you look under the hood, as it were, look at the detail of this inflation data. And the problem is, the worry for the Bank of England is that we have some stubbornly high service sector inflation. And that's what's worrying the Bank of England and its rate setting committee, the MPC. That's the reason. It's a focus on the economy, the sector that is really driving the growth in the UK economy has got more inflation than the Bank of England would like. The price of goods, a lot of physical goods, have actually gone negative, so are actually falling. But that, combined with higher than anticipated service sector inflation, is producing a rate of 2%. Does anyone actually believe government data anymore? Says Connor. Well, Connor, I've got nothing else to believe. I like you, we often get revisions. So there are a lot of people who spend their lives, economists and analysts, whose day job is to sift through all this, and their job is to produce. When you see all of the data here, this calendar that you're looking at on the screen, Connor, tells us, let's go to the current week. It tells us what's expected. And the forecast is not something that the government are telling us. It's what economists polled by Bloomberg are actually expecting. So a lot of people can work it out. For example, we knew or we anticipated that inflation would fall to 2% last week because of the base effect. And it duly did. So when we talk about believing government's data anymore, it's produced by the Office of National Statistics, which is part of the government organization, but it's apolitical, obviously. Its job is just to collate data. That's all it does. The trouble is, data ebbs and flows, but that's what drives our market, Connor, and that's what we want. We want uncertainty. We want a measure of volatility to be able to trade off. That's really what we're looking for. Anyway, so there we go. UK Bank of England, probability of a rate cut in August, slightly lower. There isn't a meeting in July. That's why I haven't mentioned July. The Bank of England met last week on the 20th. As you know, they kept interest rates unchanged. They implied that there was a slightly higher probability of a rate cut, but the market didn't like some of the comments and reference to the service sector inflation. The next meeting actually is on the 1st of August, so we've got to wait until then. So you can take your July, you can relax, or not. If you need interest rates to come down because you've got a mortgage you want to refinance, then you want it to happen sooner rather than later. Yeah, I'm sorry about that. US dollar, a quick look. We could look at the US dollar there. A better week. Yeah, the dollar strengthened last week. Better than expected manufacturing and service data that I've just been talking about on Friday. I think it's pushed the probability of a second rate cut in November lower by, I think I worked out 6%. Not a big deal really, but the euro was, what was the euro down? Well, down a lot actually on the week. No, it's sort of, so that was the close the previous Friday. I'm just hovering over there. So yeah, it just a very unchanged, a little bit lower. The euro was. Sterling also in the same bracket, about 0.5% lower from the previous week. The big one, the exciting one, and the one you've got to be a bit careful of is the Japanese yen. The Japanese yen nudging 160 yen to the dollar. So as this price goes up, this is the number of yen to the dollar. That is the yen weakening significantly, or the dollar strengthening. Look at it when you go back. Wow. Wow. You keep going back. And this is where we've come from in early 21, sort of 105, 108. Why? Because of the unrelenting, easy monetary policy pursued by the Bank of Japan. They more belatedly, they've started to raise rates to a whopping 0.1%. There you go. You're not going to rush to put your money in yen, are you, to get 0.1% when you can get 5.25% in the UK? No, you're not. Anyway, 160. Why am I talking about a risk at 160? Well, it's the level we last hit on that day, the 29th of April, and that was the day when the Bank of Japan intervened, only modestly, but it frightened the market and it came off flying off. It looked like it was just going to accelerate, but and that's the possibility now, and there is a threat of intervention here around the sort of 160 level. Anyway, it's sort of a multi-year low for the yen, or high in terms of price, and that's the level, as I said, it touched briefly at the end of April. I think the prospects for a further increase in interest rates by the Bank of Japan looks a little bit uncertain. The council, the governing council, and the governor, a chap called Ueda, stated that the Bank of Japan had not ruled out a rate hike next month, but I think investors and traders starting to feel it's less likely. Hence the reason why the Japanese yen continues to fall as a number of, that's the number of yen to the dollar. So that's the yen falling, and falling quite precipitously. Oil, that's another mover. Yep, oil up $2.50 last week. Stuart saying it was just horrendous for all of May, just not good. But that's, you know, we don't blame anything. It's just the way markets are. Markets ebb and flow, and we don't make the markets up. We have to have our strategies so that we can cope with these sort of fluctuations, and that's the reasons, obviously, why we have our stop regime. But there we go. Eventually, you know, we get a dip, and it looks like oil's going to fall out of bed. Then look at it, just sharp rally, and it's rallied what, $2.50 last week on. Well, actually, I had it on UK oil. Anyway, it's the same deal. Charts looks the same. Touch levels last seen in the 1st of May. So, you know, we're making multi-week highs, and it's all down to the ongoing tension in the Middle East, supply constraints because of what's happening in the Red Sea. There had been some Ukrainian strikes on Russian refineries, and yeah, I think this is sort of time when the US refineries have their maintenance, which You think it actually slow the consumption of oil, but actually it then distorts the distillate market. Anyway, it's a bit of a complicated picture, but oil's going up. That's all we need to know. Yeah. Gold, I've been asked a question about gold. Yeah, it didn't do much last week. It fell 10 or $11 really. Yeah, the fall on the Friday, that was really because the strong data in the US, which pushed the dollar higher, and being a dollar-based commodity, gold, it reacted down on the back of it. But Chinese central bank buying, Chinese retail buying, other central bank buying as well. So all this sort of demand continues to support the gold market, and the sort of move we saw last week is nothing compared to the rally from where we've come from over the last since February. Look at that, 1991. So it's been a huge move for gold. Right, markets calendar. What's coming out this week? Get onto the right week might help. A quiet week. Yeah, really is a quiet week. It sort of goes like that. We've got a busy week next week, but this week is a quiet week. And I think the highlight of the week is probably the US PCE data, the personal consumption expenditure price data due out on Friday. Anyway, we've started off with a chap called Christopher Waller, who's a member of the Federal Open Market Committee that sets interest rates. He delivered the opening remarks at some central banking research conference in Rome. Otherwise, you'd be thinking, why would he be talking at 8 o'clock our time, which is sort of 3 o'clock in the US? But no, he's over in Rome. Anyway, he's regarded as a bit of a dove on interest rates. What that means is a dove, he's not wanting to see rates stay high. He preferred to see a cut in rates. And the dollar could be sensitive to anything he said, but clearly he didn't say anything that dramatic. Otherwise, it would have moved. IFO business climate. Yeah, it's something I've followed over the years. It's a very large survey of everyone in Germany: manufacturers, builders, retailers, wholesalers, and I think the mood in the Eurozone bloc's largest economy, I think it has improved over the last 3 months. It was looking pretty dire, and I think the index is expected to remain unchanged from last month's reading, but yeah, it's come out and it's lower. Yeah, so it's just come out 10 minutes ago. Yeah. Well, not great reading, but not dire reading, but it just goes to show you how fragile and still wounded the German economy is following the problems with its energy, the energy crisis, and one of its biggest market, China, really just going into reverse, as we know. So it's had a bit of a perfect storm of negative influences. Okay, Tuesday, the bit that sticks out for me, or the one that sticks out for me, is this CB consumer confidence. So the CB stands for Conference Board. It's the first of 2 readings of consumer confidence this week, the other one being at the end of the week, which is a revised one from the University of Michigan. Expected unchanged from last month's reading, but it can create waves in the foreign exchange market, and US dollar and US assets are likely to be sensitive to that release. That's why we're looking at it. Wednesday, nothing really worth looking at, new home sales, but that's not a big move, and not as far as I'm concerned. So we have to move to Thursday. We've got Andrew Bailey, the governor of the Bank of England. He's reporting on the financial stability report, which is where the Bank of England makes sure that the financial system is stable and there aren't things that potentially could disrupt it. Crypto was a big one a couple of years, 2 or 3 years ago. But anyway, he's holding a press conference about this report. No, I don't expect there to be any effect on sterling or UK assets really from the back of this, but I suppose he could say something about interest rates, but it's unlikely. We then have the final reading of GDP, and they put this as a sort of high impact reading, which I'm never quite sure about, because it's the last of 3 readings. So basically, the way the data agency that puts this together collates the information. It only has about 40% of the data when it releases its preliminary reading. So it has a prelim, it has an advance, and then it has it has an advance, then a prelim, then the actual number, the final number. Anyway, when it starts producing the data, it's only got 40% of it. Anyway, the majority of the data is in now. The Bureau publishes its third and final report. There's a slight uptick expected 1.4%, but that's lower than the fourth quarter in 2023. Yeah, that's what we're talking about. So this is still talking about Q1 up to the end of March. Little impacts expected, really. A lot of analysts are now focused on what the numbers will look like for Q2. As I said about 20 minutes ago, this is the end of Q2 on Friday, the end of H1 and the end of June. So next week, it's all start of the new second half of the year, the third quarter, and July. So anyway, but so I don't think there's going to be a lot of interest in that final GDP reading. On Thursday, we also have the first of the presidential election debate. I'm mentioning it because a lot of people are talking about it. I'm not sure what the outcome's going to be, but you've obviously got President Joe Biden and past President Donald Trump appearing. And analysts really do say they don't know how this is going to affect polling. So the outcome, I guess, is as uncertain as the election is on the 5th of November. I think, gosh, with the UK elections here, French elections over the next 2 weeks, there's a lot going to be changing this year with new leaders probable in all three. Well, definitely in the UK, likely in France, and probable in the US as well. Yeah. And then we get on to the cordial, because I wasn't going to talk about that either, and it's because it's been downplayed to medium impact. I won't, and it's due. You can see what is expected, but it's core durable goods excludes all the really big ticket items like transport, aeroplanes, and all the cars and stuff which distort it. And Friday, that's the one. We've got this core PCE. So many mnemonics in the financial markets: GDP, PMI, CPI, HPI. Yeah. Anyway, PCE, Personal Consumption Expenditure Price Index. And that's the preferred measure of inflation used by the Federal Open Market Committee, the committee that sets interest rates at the Federal Reserve. So that's why we all look at the PCE. No one used to, well, not until about sort of 3 or 4 years ago. And the expected core rate reading is at 2.6%. That's what we're looking for, down from 2.8% in April. And yes, they're only showing a monthly reading here, down to plus 0.1% from plus 0.2%, but on an annualized basis, 2.6% down from 2.8. And that would tie in with the official CPI data that was released a couple of weeks ago, which we talked about early on. Anyway, dollar, US assets will be very sensitive to this release, because obviously it'll have a direct impact on the decision-making process within the FOMC, because their job is to adjust interest rates to manage inflation and price stability, and they've got a target of 2%. So unless inflation is heading down there, they're not going to be cutting rates, are they? So this will have a big effect on them. So so you've got to wait until 1:30 on Friday before the most important data release of the week. There you go. Such is life. Anyway, that's it. Go and walk the dog. It's lovely sunny weather, I think, today, tomorrow, and Wednesday. So you just never know with the British weather. Just grasp it. Just never know. I was up at 5 and I went outside. Lovely. Just lovely. Nice and quiet as well. Anyway, good stuff. Thank you very much for listening. You've been very quiet, but maybe it's because I've been covering it all and explaining it all so well. Or it's possible you've already gone to walk the dog and haven't told me. Anyway, thanks very much. If there aren't any more questions, we will call it a day. A little bit earlier than usual. But anyway, listen, have a good rest of the week. Thanks very much for attending, and we'll go through it all again next Monday. All the best. You have a good week. Yeah, bye for now.